The dot-com bubble caused a loss of $7 trillion. This loss is more than the GDP of many countries. It was a bizarre thing when we were transitioning from the 20th to the 21st century. The first thing in the 21st century we saw was a financial crash. The story of the dot-com bubble is a fascinating journey through a period of incredible optimism, blinding speculation, and a harsh awakening. To understand it, we need to rewind back to a time when the internet was still a mysterious thing for most people. The internet didn't start in the 1990s. It actually began as a government project in the 1960s, which developed the first version of the internet. In the 1980s, it was limited to scientists and government workers. Things changed in the early 1990s when a British computer scientist created the World Wide Web. It made the internet easy to use. After that, the release of the Mosaic web browser in 1993 made it even easier. In 1994, the Netscape Navigator browser was launched. It quickly became the dominant browser. Suddenly, the internet wasn't just for scientists, it was for everyone. In 1995, Netscape went public, and on the first day of trading, Netscape's stock price doubled. This was the moment when investors realized the internet could be a big business. After this, internet startups started popping up. Many had no clear plan to make money, but that didn't matter. Investors believed the internet would change everything, and they didn't want to miss out. The years between 1995 and 2000 marked the full-blown inflation of the dot-com bubble, driven by a belief that the internet had given birth to a new economy. Profitability, which is considered the fundamental part of a good business, was dismissed as an outdated concept. Instead, the mantra became, "This time it's different," asserting the internet will change the fundamentals of the business. The focus shifted completely to attention and market share. Companies were encouraged to acquire as many users as possible, even if it meant losing money on every transaction. They assumed that profits would come later, once a dominant position was secured. This led to a strategy of growth at any cost, where rapid expansion and aggressive marketing were prioritized over sustainable business models. The VCs poured billions into unproven startups with no due diligence. Their strategy was to invest in numerous companies, hoping that a few would hit it big enough to offset the losses from the many failures. The VCs only looked for having the .com suffix in a company's name. That was enough for them to invest in a company regardless of the underlying business plan. As if the blind investing of VCs was not enough, the ultimate validation of this speculative craziness came with initial public offerings. The IPO market came in huge demand, with companies boasting no revenue and no profits seeing their stock prices multiply dramatically on their first day of trading. The Globe.com, an early social networking site, saw its shares surge by 606% on its IPO day in November 1998, while VA Linux went public in December 1999 with a 698% gain. These massive, instant returns increased the public's appetite for tech stocks. It created a valuation disconnect where new internet companies were valued higher than established, profitable corporations with decades of operational history. The Nasdaq climbed from around 1,000 points in early 1995 to over 5,000 points by March 2000. The media also played a significant role in amplifying the hype. The finance and news channels turned stock market updates into a daily drama, broadcasting every rise and fall with breathless excitement. At the same time, celebrity analysts emerged, whose bullish predictions often moved markets, further encouraging speculative behavior. Online brokerage firms also started popping up during this period. These firms made it incredibly easy for anyone with an internet connection to trade stocks. This led to the day trading craze, where ordinary individuals, from taxi drivers to college students, quit their jobs and were convinced they could make a fortune by buying and selling stocks multiple times a day from their home computers. The fear of missing out became a powerful psychological factor, pushing more people into the market. Initially, government and monetary policy of the Federal Reserve arguably contributed to the bubble's inflation. The low interest rates provided a lot of liquidity, making it cheap for companies to borrow and for investors to take on more risk. The dot-com bubble saw some truly bizarre and unsustainable business models. The most iconic example of bubble-era absurdity was Pets.com. Launched in 1998, its premise was simple: sell pet supplies online. It gained widespread recognition through its unforgettable sock puppet mascot, which even starred in a multi-million-dollar Super Bowl commercial. Despite the massive marketing spending and brand recognition, Pets.com faced fundamental challenges. Shipping heavy, bulky, and low-margin pet food was incredibly expensive. Customers could often find the same products cheaper and more conveniently at local stores. The company burned through approximately $300 million in just 2 years and famously went bankrupt in 2000, becoming a symbol of the dot-com bubble. Another prime example was Webvan, an online grocery delivery service founded in 1999. It raised over $800 million from investors and built massive automated warehouses and bought fleets of delivery trucks, spending lavishly before even establishing a significant customer base. Their ambition was to revolutionize grocery shopping, but they fundamentally underestimated the incredibly complex logistics and thin profit margins of the grocery business. They promised fresh produce and competitive prices, but the high operational costs of delivering individual grocery orders quickly became unsustainable, leading to its failure in 2001. Another business was Cosmo.com, which represented the ultimate indulgence of the convenience economy. Launched in 1998, it promised one-hour delivery of videos, snacks, magazines, and even Starbucks coffee, all without a delivery fee or minimum order. They raised over $280 million, had a presence in major U.S. cities, and were heralded as the future of urban convenience. However, like Webvan, the logistics of delivering single items rapidly were prohibitively expensive, and the unit economics simply didn't work. Their cash burn rate was alarming, leading to their closure in 2001. Then there were the fashion casualties, like Boo.com. Launched in 1999, it aimed to be a high-end online fashion retailer, promising a cutting-edge 3D shopping experience. However, the website was notoriously slow and difficult to navigate, especially when the internet ran on slow dial-up networks. The company also spent lavishly on marketing, expensive offices, and an international presence before even launching successfully. It burned through $135 million in just 18 months and collapsed in May 2000. Beyond consumer-facing companies, some sought to create entirely new digital infrastructures, often with similar results. Flooz.com and Beans.com attempted to introduce proprietary digital currencies that consumers could earn as rewards and spend at participating online retailers. Flooz's idea was to create a universal online loyalty program, but consumers largely failed to grasp their utility, and they struggled to gain widespread adoption. During the bubble, companies focused the least on their products and spent millions on extravagant launch parties and corporate events, sometimes even before their websites were fully functional. The Super Bowl was filled with unknown dot-com ads spending millions. While Pets.com's sock puppet was memorable during the Super Bowl, countless other ads from companies that quickly vanished served as expensive marketing spend. At the time, how quickly a company spent its venture capital was often seen as a badge of honor, a sign of aggressive growth and ambition, rather than a warning of potential insolvency. The prevailing logic was that spending big now would lead to market dominance, and profitability could be figured out later. This mindset, coupled with endless capital supply, created an economic bubble. Many ordinary employees were getting paid partly in stock options. They became paper millionaires overnight when their companies went public. These people, who were new to the world of finance, genuinely believed their wealth was real and would only continue to grow. The burst from March 2000 to 2002. This crazy party couldn't last forever, and the music finally stopped on March 10, 2000, when the Nasdaq reached its all-time peak of 5,050 points. But after this, what followed was not an immediate catastrophic crash, but a slow, agonizing descent that gradually turned into a freefall, ultimately deflating the bubble over the next 2 years. Several factors contributed to triggering the burst. The primary one was the actions of the Federal Reserve. The Fed began raising interest rates in mid-1999 and continued to do so into 2000. It aimed to cool down an overheated economy and curb inflation. The higher interest rates made borrowing more expensive for companies and made safer investments like bonds more attractive. It drove the capital away from risky tech stocks. On top of that, many dot-com companies started reporting disappointing earnings for the first time. They couldn't meet their optimistic revenue projections that had justified their sky-high valuations. Their promises weren't translating into meaningful revenue. So investors began demanding to see the fundamentals, like actual earnings, cash flow, and sustainable business models, rather than just potential. This renewed scrutiny quickly exposed all these companies that were just thriving on speculation. Also, when founders and early investors realized the market was almost at its peak, they quietly began cashing out some of their shares. As all these factors combined, investor confidence began to erode and panic selling started. As stock prices plummeted, more investors rushed to sell, creating a vicious downward spiral. The once booming flow of venture capital dried up almost completely, leaving thousands of cash-strapped startups with no lifeline. Companies that had once been worth billions saw their market value shrink to mere millions or even disappear entirely. Pets.com famously shut down in November 2000. Webvan went bankrupt in July 2001. Boo.com dissolved in May 2000. These companies, and thousands like them, failed because their business models were fundamentally unsustainable, built on a foundation of rapid spending and vague promises of future profits, rather than actual revenue generation and disciplined operations. The Nasdaq ultimately lost nearly 80% of its value from its peak, a staggering wipeout that took years to recover from, plunging the tech sector into what some called a nuclear winter. Thousands of dot-com employees, many of whom were young and had bet their futures on these companies, faced mass layoffs. Offices that were once buzzing with activity, fueled by free gourmet coffee and late-night coding sessions, became empty shells. Workers who had relocated for their dream jobs found themselves jobless, holding worthless stock options. For the public, the bust meant lost savings and retirement funds. Many everyday investors, lured by the promise of easy money, had poured their life savings into tech stocks, only to watch them evaporate. The collective wealth destruction amounted to trillions of dollars, impacting individuals across all economic strata. The period immediately after the dot-com bubble bust was characterized by a deep sense of cynicism towards anything associated with the internet. If you look at the companies that came during the bubble, many of them had a great idea, but the problem was they were too early. At the time, the internet was still a new thing for the public. People were not dependent on it for anything. By the year 2000, the internet penetration was around 40% in the US, so mass adoption by the public for many things was too quick. This is one of the reasons that many of these similar companies did not work out back then. But today, similar companies are thriving when the internet reach is above 90%. However, amidst the widespread destruction, there were surviving companies that, despite having their valuations slashed, had robust enough business models or adapted quickly enough to weather the storm. Amazon.com saw its stock price drop by over 90% from its peak. Yet, unlike many of its peers, Amazon's relentless focus on customer service, building out its underlying infrastructure, and a long-term vision for e-commerce allowed it to survive and eventually thrive. eBay, with its marketplace model, also demonstrated resilience, as transaction-based revenue was more sustainable. Perhaps the most successful internet company that started at the peak of the bubble was Google. It was founded in 1998. Google did not go public until 2004. Their focus from the start was on developing a superior search algorithm and, crucially, a highly profitable advertising model that monetized user activity effectively. There are some people who also made money from the bubble. A prime example is Mark Cuban, who sold his company, Broadcast.com, an internet radio company, to Yahoo for $5.7 billion in April 1999. He sold the company just months before the Nasdaq peaked. Cuban converted most of his Yahoo stock to cash shortly thereafter, securing his fortune before the crash. Others who profited were short sellers, investors who bet against overvalued stocks, making money as their prices fell. As said in the movie Margin Call, the investment banks do not miss the opportunity to make money. The investment banks made a lot of money for their role in hyping IPOs. They generated significant fees from underwriting the massive volume of public offerings during the bubble's peak. One of the questions that often arises is, did the dot-com bubble set the stage for the 2008 financial crisis? The short, direct answer is no. But indirectly, it did set the stage for the 2008 crisis. The Fed's monetary policy response to the dot-com bubble played a big role. To prevent a deeper recession after the bubble and the 9/11 attacks, the Federal Reserve aggressively cut interest rates, bringing them to historic lower levels. The low interest rates encouraged borrowers to borrow more. When people had more money, they invested more in real estate. It drove up home prices. Also, money that exited the tech sector needed a new home, and some of it flowed into other asset classes, including housing and other complex financial instruments. From 2002 to 2008, another major bubble was building up, which caused a global recession. What exactly happened in the 2008 crisis and how some people saw it coming long before anyone else and made insane profits. All of this you can learn in this video.